In today's episode, we'll break down one interesting story in depth, followed by a shorter story. First, we'll talk about the split personalities of Indian FMCG, and then we'll talk about why India's net NPAs are at a historic low. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Friday, 28th August. Before we begin, in the latest episode of Subtext, we host Dr. Rohit Chandra, who is the assistant professor at IIT Delhi School of Public Policy, to give us a history of India's power sector and the role of coal in it. The podcast uses coal and broadly energy as the centerpiece to talk about various episodes in the history of the Indian economy, from the 2010s NPA crisis to how India's biggest PSUs work, to our Cold War strategy, to ministerial turf wars within the Indian government, and to vertical integration. You can watch the full episode on YouTube or listen to it on Spotify and Apple Podcasts. Coming to the first story. For quite some time, the big consumer goods giants of India have been navigating a tricky landscape. For one, that pack of biscuits or chips, or even the bottle of skincare lotion you buy, might have been feeling a little lighter by weight while being the same price. It's also possible that prices of these items have increased slightly. They've been playing a game of seesaw of value and volume to protect profits. At the same time, the companies making these daily essentials are now promoting a lot of high-end products like protein snacks, face serums, and so on. That's in line with the trend of premiumization that we've been talking about on the Daily Brief for so long, and much of it has been driven by urban consumers rather than rural ones. Meanwhile, raw material costs have spiked due to a historical oil crisis, creating an urgency for the industry to find new growth drivers as soon as possible. Now, these sound like disparate images, but they're really part of one cohesive story for which we'll be looking at the latest quarterly earnings calls of four FMCG companies: HUL, Marico, Britannia, and Nestle India. Which only means one thing: revenues went up because of a price effect. Now, that could mean a price hike, but mostly FMCG firms pursued another strategy: shrinkflation. So instead of raising prices outright, companies quietly trimmed a few grams off a package while keeping the price at a familiar 10 rupees or 20 rupees. And companies do this knowing that it might hurt volumes. Obviously, there's a limit to how small a biscuit packet can get before consumers notice and start looking for alternatives. This is where companies diverged this quarter. Marico, for instance, chose not to implement any additional grammage reductions on its flagship Parachute coconut oil, and instead, management attributed the brand's resurgence to adjusting prices downward on its larger family loyalty packs. So Marico saw some of their fastest quarterly growth in a while, and that's also why it recorded its highest profit growth in nearly 2.5 years. But Marico was an outlier. Many companies committed to more shrinkflation or even price increases. Britannia, for instance, openly admitted to still trimming packet sizes, and HUL, meanwhile, actively implemented price hikes this quarter while also signaling future hikes are possible. This was primarily done to offset cumulative palm oil and packaging inflation, which we'll eventually talk about. But yet, despite that, these companies also benefited from very strong volume growth. Britannia saw sales volumes recover, while HUL enjoyed price and volume growth equally, contributing to what's their best growth period in 13 quarters. And there are clear signs that volume growth seemed to have returned across the board. Now, with the festive season approaching, FMCG firms expect to drive even higher volumes, which is why they've stepped up their ad spending at a blistering pace. Nestle India, for instance, hiked its ad spend by over 40%, while HUL spent over Rs 1,657 crore on brand building in a single quarter. So to see where this actual volume growth is coming from, you will have to look at two very different parts of the Indian economy: small rural kirana stores and 10-minute delivery apps in cities. So let's start with the former. Between 2021 and 2023, rural sales were sluggish as village households dealt with high food inflation and unpredictable monsoon seasons. But recently, rural India seems to have staged a comeback. as FMCG rural volumes seem to be outpacing or at least matching that of urban areas. So, what made rural demand come back? The well known explanation is disinflation. So, a drop in general food inflation means rural families who spend a massive chunk of their budgets on daily food should have more disposable cash left over. However, beyond this disinflation, real rural wages have not meaningfully increased over the past 2 years, and FMCG firms themselves are among the first to admit that. So, what that means is that farmers didn't earn more from what they produced. Either crop output remained muted, or even if it rose, farmers couldn't earn more from it. In essence, farm productivity hasn't improved and agriculture hasn't moved the needle much. So, if inflation trends, which can be fickle, reverse, then rural growth goes back to square one again. We covered this trend last year. So, if wages were flat and the harvest itself only grew modestly, what actually put more money in rural pockets this cycle? That answer came from HUL itself. The government raised the minimum support price on crops by around 5 to 6% this cycle. But yet again, that's a temporary price effect meant to support farmers through a rough El Nino season. It's not a structural volume effect. So, if MSP increases tone down in the future or don't keep pace with any renewed inflation, the rural income cushion that's currently propping up FMCG volumes could disappear. As a result, the network of Kirana stores that forms the backbone of rural retail, also known as traditional general trade, is bustling again. HUL's traditional trade channels are back in positive territory, while Nestle India confirmed that its volume growth was led primarily by rural markets. And Marico saw double digit volume growth in general trade thanks to its rural expansion push. Now, part of this rural growth came from companies fixing their own internal glitches. Britannia's general trade grew 1.5 times faster than its rate for the entire previous year. But that was largely unlocked after the company completely eliminated something called dual pricing. So, this dual pricing isn't about charging the consumer two different MRPs, but is rather a glitch on the B2B side of things. Sometimes companies offer steeper discounts or older inventory to massive, unorganized wholesale markets, and this creates a dual pricing effect, meaning a box of biscuits is suddenly cheaper in the wholesale market than it is coming directly from the company's official rural distributor. And since rural Kirana owners operate on razor thin margins, they'd rather buy that box for 92 rupees at the wholesale market than from the official distributor trying to sell it for 95 rupees. But that, in turn, fills up the distributors' warehouses with unsold stock. And as a result, they stop placing new orders with the FMCG firm whose official rural volume growth then plummets. So, this dual pricing issue had previously disrupted wholesale channels in April and May, but its elimination brought unorganized retailers back in droves in June, allowing Britannia to exit the quarter with mid-teen sales growth. Meanwhile, urban cities are seeing a massive shift toward quick commerce and premium products. So, India has been seeing what is often described as a K shaped consumption boom. So, here the upper income bracket, which is the top arm of the K, sees surging wealth and spends aggressively on premium goods and lifestyle upgrades. Meanwhile, the lower and middle income segments face stagnant incomes, forcing them to tighten their belts. And this divergence is visible across sectors. For instance, as per Franklin Templeton, sales of premium TVs and high value autos have surged by 18% and 28% respectively, while mass market appliances and lower value autos have seen volume declines. Now, consumer companies are leaning heavily into the top half of the K by expanding their premium and health focused lineups. For example, HUL saw rapid double digit growth in premium body washes and skincare brands like Simple, Pond's, and Vaseline Gluta-Hya. Britannia's premium croissant business grew over 30%, doubling its run rate to roughly rupees 200 crore with profit margins that match its core business. Meanwhile, Nestle India reported that its premium Nescafe coffee variants recorded double-digit volume-led growth. So much of this urban growth is now being driven by quick commerce. HUL sales on quick commerce apps are growing between 40% and 50% year on year, while Marico saw a 50% jump in e-commerce revenue primarily due to QCom. And Britannia revealed an even more striking stat. Quick commerce now makes up an overwhelming 80% to 85% of its total e-commerce sales. And this shift has forced companies to overhaul their supply chains. Meanwhile, Nestle India pointed out that because quick commerce dark stores operate with just 2 days of physical inventory, suppliers have to deliver with near perfect reliability to keep products on those digital shelves. But while QCOM is exploding, it still only accounts for a small fraction of total revenue. Legacy premium upgrades like Pond's or Vaseline are growing across all traditional and modern retail channels. But quick commerce punches way above its weight in the premium category. With their short inventory model, dark stores have extremely limited shelf space, so they'd much rather prioritize stocking high margin premium items like a 400 rupees face serum over giant low margin sacks of basic staples. As a result, while legacy brands sell everywhere, digital first premium brands rely heavily on these apps to reach affluent urban customers. And many of the acquisitions made by legacy FMCG players are geared towards this strategy. HUL in particular has been quite aggressive with its M&A strategy. Last year, it acquired digital first skincare brand Minimalist, and then earlier this year, it executed a complete buyout of plant based nutrition brand Oziva. Similarly, Marico's digital first wellness portfolio, comprising brands like Plix, Beardo, and Cosmix, crossed a combined run rate of Rs 1,100 plus crore, with Beardo notably delivering double digit profitability through online channels. Now, FMCG companies are simultaneously dealing with a fresh wave of raw material inflation, and much of it is driven by the Strait of Hormuz disruption, which increased the price of crude oil and gas, which are key inputs in the manufacturing process. And plastics are also a byproduct of crude oil, which means that packaging costs for these firms also spiked. So, for Marico, global prices of copra, which is the kernel of a coconut that's used to extract coconut oil, were discounted by 30 to 35%. Meanwhile, global energy and hydrocarbon cycles drove up prices of crude oil linked polymers like HDPE and liquid paraffin packaging inputs significantly. Ultimately, due to softer copra prices and a favorable portfolio mix, Marico saw a 30 basis point expansion in gross margins. Britannia, conversely, faced severe margin pressure from the prices of refined palm oil rising and packaging laminates inflating. Crucially, a large part of its baking uses LPG and CNG, both of which shot through the roof in April and May. As a strategic hedge against gas volatility, Britannia leaned more on biomass, and HUL followed a strategy of only passing on half of its cost increases in Q1 FY27, but didn't rule out future measured pricing steps. At the end of the day, the Indian consumer goods market is no longer a simple game of flooding kirana shelves with basic staples or relying on price tag tricks. The rules of the game have fundamentally changed. To win today, FMCG giants must run a delicate, high speed balancing act, capturing mass volume demand from a recovering rural core while simultaneously racing to deliver 10-minute convenience to urban consumers eager to splurge on everyday luxuries. With this urgency to adapt to a new consumer landscape has come a massive wave of leadership reshuffling across HUL, Britannia, Dabur, Colgate, and so on. And companies are actively bringing in new executives and CEOs that may be best suited to navigating such a medley. As the festive season approaches, the industry is hoping for a stronger period of demand. But with input cost volatility persisting and US Iran tensions only escalating, while El Nino continues to threaten the year's crop season, it'll be difficult to say how bright the festivities might be. Coming to the second story. So, a chart by Zerodha Capital on Indian banks went viral recently. It showed the net NPA ratio falling from 6% in March 2018 to 0.4% in June 2026. CareEdge, whose calculations underlie the chart, says asset quality has now improved for 20 consecutive quarters. So, this chart gives us a pretty good 30,000-foot view of what has happened to Indian banks over the last few years. But the line by itself doesn't tell us why this happened. And that matters because FY18 was also an unusually bad starting point coming after the RBI's asset quality review forced banks to recognize a lot of stress that had built up over the previous credit cycle. So, to understand how net NPAs went from 6% to 0.4%, we need to look at what changed underneath that line. The first clue sits in the metric itself. This chart is not showing gross NPAs. It's showing net NPAs, which means bad loans left on the books after banks have already set aside provisions against expected losses. And that distinction matters a lot. Gross NPAs tell us the total stock of loans classified as bad. Net NPAs tell us how much of that stock is still effectively uncovered after provisions and other permitted deductions. And Indian banks have become much more aggressive about provisioning. So in March 2018, Indian banks' provision coverage ratio was only 48.3%. In other words, they had provided for less than half of their gross bad loans. But by March 2025, provision coverage had risen to 76.3%. So even if the underlying bad loan didn't disappear, a larger part of the expected loss had already been recognized and absorbed through the bank's profits. Now, that alone pushes the net NPA ratio down. It's one big reason the chart looks as dramatic as it does. Higher provisioning explains part of the fall in net NPAs, but the underlying stock of bad loans also shrank sharply. So, scheduled commercial banks had rupees 10.40 lakh crore of gross NPAs in March 2018, but by March 2025, that had fallen to rupees 4.32 lakh crore. So, that can happen in two ways. Fewer fresh loans turn bad, and old NPAs leave the pool through recoveries, upgrades, or write offs. Now, the first is probably the more important part of the story. Banks added rupees 6.04 lakh crore of fresh NPAs in FY18, and by FY25, annual additions had fallen to rupees 2.26 lakh crore, even though the overall loan book had become much larger. So it shows fresh NPAs added during the year as a share of the standard loan book at the start of the year. But that ratio fell from 7.6% in FY18 to 1.4% in FY25 and further to 1.2% in FY26. So this is not just old bad loans being provisioned away. Far fewer performing loans are turning bad in the first place. Now, the other side of the equation is how old NPAs leave the system. In FY25, banks removed rupees 2.75 lakh crore from the gross NPA pool, and of this, recoveries and upgrades accounted for 42.8% of the reductions. Write-offs made up the remaining 57.2%. Now, recoveries are straightforward. The bank gets some money back, whether through direct collection, settlements, IBC, SARFAC, or other recovery routes, and upgrades are loans that stop being NPAs because the borrower clears the required dues and the account returns to standard. But write offs are different. The bank removes the loan from its reported balance sheet, but that doesn't necessarily mean the borrower is forgiven. The bank can still continue recovery efforts. Now, this matters because write offs have been the single biggest route through which old NPAs have left banks' books. But they're not a separate explanation for the fall in net NPAs. By the time a loan is fully provided and then written off, most of the reduction in its net value has already happened through provisioning. So, put simply, provisioning brings down net NPAs, and the eventual write off cleans up gross NPAs. Now, there's one more reason the ratio fell. The denominator got much bigger. So, gross advances of scheduled commercial banks rose from rupees 92.66 lakh crore in March 2018 to rupees 194.49 lakh crore in March 2025. So, the loan book more than doubled in 7 years. Even if net bad loans had stayed flat, spreading them over a much larger loan book would have pulled the ratio down. But this was not just a denominator effect. Net NPAs themselves also fell sharply from rupees 5.21 lakh crore to less than rupees 1 lakh crore. So both things happened at once. Banks had fewer net bad loans and a much larger loan book. The 0.4% net NPA ratio is a useful snapshot, but it's also the end result of a very specific credit cycle. Banks recognized a large pile of old stress, provisioned heavily against it, recovered or wrote off bad loans, and then grew the loan book on top of that. At the same time, fresh slippages fell sharply. And a lot of that cleanup was concentrated in the corporate loan book, where the last cycle did the most damage. But that problem is now much smaller. But credit cycles do not disappear. When stress falls for long enough, lending standards can loosen, risk can build in new pockets, and eventually some of it shows up again. Today, some of those pockets are visible in parts of retail lending and microfinance, even if they're nowhere close to the scale of the old corporate NPA problem. But that doesn't tell us where NPAs go next. It's just worth remembering that a historic low is not the same thing as the end of the cycle. Now, coming to the tidbits. 1. As AI drives a boom in data center construction, operators are increasingly hiring acoustic consultants to address noise from cooling systems, generators, and other equipment. Specialists are helping developers design mitigation measures, comply with local regulations, and reduce community opposition. 2. The Food Safety and Standards Authority of India has issued show cause notices to luxury hospitality operators, including JW Marriott and Juniper Hotels, citing violations of hygiene, labeling, and storage protocols. The regulatory action follows inspections that uncovered deficiencies in sanitation and food management. 3. Flipkart's quick commerce service, Flipkart Minutes, has surpassed Swiggy Instamart in the number of dark stores across India's top 10 cities. According to a CLSA report, Flipkart now operates 627 micro warehouses compared to Swiggy's 615 in these key markets, reflecting intense competition as companies rapidly expand physical infrastructure to dominate the 10-minute delivery sector. 4. Bharat Petroleum is leveraging its large LPG distribution network to deliver groceries alongside cooking gas cylinders. To support this non-fuel expansion, the state-owned oil marketing company is developing its own e-commerce platform and digital payment gateway with pilot projects already underway. 5. JSW Group has paused its proposed battery cell manufacturing project in Odisha after failing to secure a technology partner for lithium iron phosphate or LFP cells. The company noted that access to LFP know-how remains heavily concentrated in China, delaying its plans to manufacture cells domestically. That's all the news I have for you. Thank you so much for watching and see you in the next one. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.